I don't know if it's just me, but everywhere I look, I see information about Caitlyn Clark and her highlights and everything else. So I thought, hey, why not jump on the train and talk about having Caitlyn Clark money? Now, while the big deal she signed with Nike may seem like a great thing, the taxes associated are maybe not so great. So today we're going to dive into that. We're going to look at two scenarios. Caitlyn Clark, if she were just living off of her WNBA salary, and then we'll talk about her reality, which has to do with her Nike deal. This is going to be a bit of an oversimplification. There's certain things we're not going to go too deep in the weeds on, but despite that, I think you're still going to find a lot of value, and you're probably going to be mind blown by the total taxes that add up and how something as simple as what state you live in can make a $100,000 difference. So for today, we're going to use a tool that we use called HolistiPlan. It's one of the top tax and financial planning tools in our industry, and it does a great job of getting right to the bottom line of what taxes are going to look like for different scenarios. So let's start with the WNBA contract. Her salary is $76,500 per year. So if we assume that's all W-2, and again, we oversimplify. We don't assume she's putting money towards a tax-deductible health insurance. We don't assume she's putting money into a 401k. If we just look at that $76,500, take away the standard deduction, and then apply federal and state taxes, we can then calculate how much Caitlyn Clark would owe in taxes. For this example, we're going to use Iowa as her state of residence. So for federal, her tax would be $8,679. For state, it would be $3,201. So all in, her total federal and state tax would be $11,880, which works out to about 15.5% of her salary, which is $76,500. So in other words, a W-2 employee earning $76,000 or so a year, they're getting to keep about 85% of their money, and in total, about 15% is going somewhere else for federal and state taxes. So keeping 85% of the money you make, maybe that doesn't sound too bad. Let's then move on to the Nike deal. If you've been reading the headlines, the Nike deal is about $28 million over 8 years. If we take $28 million divided by 8, that tells us Caitlyn Clark could be making $3.5 million per year. Again, we're just assuming it's a flat, consistent amount throughout the course of the contract. Now, when you're making $3.5 million a year, you probably have some expenses. There's business expenses, there's personnel. For this example, we just assumed $500,000 every year is coming off the top to pay people. So that leaves Caitlyn Clark bringing in $3 million a year that she's going to pay taxes on. In this example, we're just thinking about her taking that money as a sole proprietor. So LLC or not, doesn't matter. We're just assuming she's a sole proprietor. And that's all Schedule C, self-employment income. So what does her situation look like? Well, the federal tax on this $3 million is, prepare yourself, $1,296,671. So almost $1.3 million in federal taxes. If that's not enough, there's also state taxes. And in the state of Iowa, that would be $170,175. So if you're keeping track, the total tax is $1,466,846, also known as 49% of that $3 million. So if you're Caitlyn Clark and we're going through this simple scenario, for every dollar you make, you get to keep 51 cents, and 49 cents goes to federal and state taxes. So again, in the first scenario, she would have gotten to keep 85% of her money. Here, we're taking a huge pay cut. She's only keeping 51% of her money. Now, if you think this sucks, let's imagine if she gets traded to the LA Sparks and she claims California as her state of residence. Well, if you don't know this already, California loves its residents, and it gives us the privilege of sun sometimes, but then also much higher state income taxes. If Caitlyn Clark, who's making $3 million a year, moves to the sunny state of California, her state tax increases from $170,000 a year to $370,000. Technically, $370,687. So an extra $200,000 per year in just state income taxes, not to mention the increased price of literally everything to live in the great state of California. So again, for every dollar she makes, if she's in California, she only gets to keep 44 cents on the dollar. Versus if you're in Iowa, you get to keep 51 cents on the dollar. It goes without saying, the state you choose to live in has some major implications on how much you pay in taxes. So this is crazy, right? Going from taking home most of your money to maybe taking home less than half. And that really illustrates the point and the power of planning. But before we get to the planning opportunities, let's talk about a couple of the reasons why her taxes are so crazy. In the United States, as you make more money, the amount that you pay towards taxes goes up. We have a marginal tax bracket where as you earn more, you pay more. On top of that, when you go beyond certain thresholds, you have additional cost. So for someone making $3 million a year, they have additional Medicare taxes. They have net investment income tax that they're paying. And since we said Caitlyn Clark was a sole proprietor, she has self-employment tax that she's paying. Self-employment tax is generally 15.3% of the net revenue or net profit that's coming from a business owner. So if you're making $100,000 a year, the self-employment tax is 15.3% or $15,300. What's important to know is with self-employment tax, half of it is tax deductible. And even when you're a W-2 employee, you're paying half of that, 7.65% towards Medicare and Social Security, also known as FICA. But as a business owner, you pay for both the employee portion and the employer portion, which can be quite a big deal. So these added costs, self-employment tax, Medicare, and then the net investment income tax, that's over $230,000 of additional taxes beyond the normal things that you and I might experience from just typical federal and state income taxes. Even further, when you have super high income, you don't get to enjoy some of the deductions and credits that others get to enjoy. So as an example, again, let's say Caitlyn Clark living off of just her W-2 income. If you're making $76,000 a year and you go out and buy a Tesla, well, you may be able to claim a tax credit. But if you're making millions or even hundreds of thousands, you're not able to claim that tax credit. And a tax credit is a dollar for dollar reduction in your tax liability. So a $3,000 credit literally puts $3,000 back into your pocket. What's really interesting is there's other credits, such as having children. For each child, you can get a credit up to certain limits. And again, if you make too much money, you don't get to enjoy that credit whatsoever. So that's literally money that could be in your bank account that you don't get because you don't meet the income limitations. So making more income, great. We're not against that. We love helping people grow their wealth and make more money. You just have to be aware of those secondary and tertiary effects when it comes to higher expenses, taxes, fees, etc. So what are the opportunities? There are many, many opportunities. What it typically comes down to is figuring out how to reduce your taxable income this year, or to perhaps shift the income liability to others in lower tax brackets, or just to the future where maybe you can have a strategy to offset the income or just pay at a lower tax bracket. So a few really quick opportunities. Caitlyn Clark could be putting money into a 401k. Depending on her structure, she could put maybe hundreds of thousands of dollars away into certain types of retirement plans. So that's one way to save money. Put it towards retirement. That could be $20,000, $30,000 a year, maybe several hundred thousand, depending on the type of retirement plan that you implement. Other strategies could be, instead of being a sole proprietor, maybe you create a corporation. That could be a C Corp or an S Corp. And by having a corporation, you're able to get rid of some of those self-employment fees. But depending on which you choose, the S Corp could be a pass-through where you set yourself a salary and take the rest as a K-1 profit distribution. Or if it's a C Corp, it's a literal entity that pays its own taxes and then pays the employees later. Now, C Corps have something called double taxation. You really want to get smart on this and work with a qualified professional if you're making more money and this becomes pertinent to you. But just know that by not just being self-employed, there are tax implications and savings that you could unlock through diligent planning. I mentioned earlier something called income shifting. Maybe you can push income to other people that are in lower tax brackets. So as an example, instead of maybe giving $100,000 to your parent just because you want to, maybe you employ them. and they're working for you and you're giving them $100,000. Now you're deducting that from your taxable liability. They're still getting the money and they're going to pay at a lower tax bracket than you. So you're able to be really giving and to be really generous without taking the whole tax bill on the chin. Another thing that you can do is look for ways to offset your W-2 income or just your current year income. This gets pretty complicated, but in general, let's just say you have $100,000 of W-2 income. And let's say you're able to do some type of other business or real estate activity that would count as active employment. And maybe you can take a loss through bonus depreciation or some other strategy. If you can offset your income with losses, you can neutralize the taxes on some parts of your money and put that money back into your pocket so you can reinvest it or do other things with it. So one of the people that I tune into is Carlton Dennis, the tax alchemist. He talks a lot about helping high income earners and high net worth people mitigate and reduce or eliminate taxes on certain pots of money. I'll link his page in the description just so you can check it out if that sounds like something that would be advantageous for you. But overall, the saying goes today as it does decades ago, more money, more problems. Taxes are a real problem. We don't want to pay less than we legally have to, but we don't want to give Uncle Sam a bonus if there's smart ways we can reduce our tax bill while still fulfilling our citizenship obligations. As always, we appreciate you tuning in. We hope you learned one or two things that you can use to better your financial situation, or at least you got to have some entertainment and learn about the first world problems of these athletes that are signing major contracts and making, more money than most of us could even hope to make in our lifetime. So see you next time, and thanks for tuning in.